You can have a good strategy. You may have watched hundreds of analysis videos. You may know how to read candlestick patterns, understand support and resistance, even know risk management in theory, but one day, your account still blows up. Not because the market hates you, not because smart money hunts stop losses, but because there are deep psychological mistakes that cause most traders to lose before they ever have the chance to become truly good. Trading is not a game for the most intelligent person. It is a game for the one who doesn't sabotage himself when money starts fluctuating. Below is the first reason, and if you see yourself in it, that's not a coincidence. Reason 1. Lack of understanding of the true nature of the market. Many people enter trading with a simple belief that this is a place to make money fast, that all it takes is a perfect method, a beautiful signal, and money will flow in steadily. They learn how to enter trades, but not how the market actually works. They know the head and shoulders pattern, but don't understand why sometimes it works, sometimes it fails. They know RSI overbought and oversold, but don't understand that in a strong trend, RSI can stay overbought for a long time before price finally drops. The problem is not in the tools. The problem is in believing those tools offer certainty. Trading is not a field of certainty. It is a field of probabilities. Every trade you take is not a sure win. It is only a situation with a slightly better statistical edge than flipping a coin. But the human brain hates uncertainty. The brain always wants to know, is this a guaranteed win? And when traders can't tolerate that uncertainty, they start creating illusions. They look at a setup, and instead of seeing probability, they see a life-changing opportunity. When you don't understand the probabilistic nature of the market, every losing trade becomes a shock. Every losing streak becomes proof that this strategy is broken. So, you system hop. Change strategy. Change time frame. Change indicators. Not because the market is wrong, but because you never truly understood the game you were playing. Professional traders don't try to be right 100% of the time. They try to be wrong in a controlled way. New traders do the opposite. They try to find a way to never be wrong, and that very mindset makes them wrong repeatedly. If you step into trading without understanding that losses are a structural part of the system, then every red trade won't just take your money. It will also take your calm, your discipline, and eventually your account. You don't lose because you're stupid. You lose because you entered a probabilistic game with the mindset of someone searching for certainty, and the market never rewards that naive belief. Reason 2. Unrealistic profit expectations. This is the sweetest trap, and also the trap that kills the most traders. Very few people enter trading with the goal: make a steady 35% per month, protect capital, survive 5 years. Most enter with a silent dream. Turn a few $100s into tens of thousands. Turn a small account into financial freedom. Turn trading into an escape from a job they hate. The problem is not having dreams. The problem is the speed at which they want to achieve them. When profit expectations are too high, every trading decision becomes distorted. You no longer look at trades through logical structure. You look at trades through one question. Will this trade double my account quickly? So, you increase lot size. Pull stop loss, closer just to trade bigger volume. Hold winning trades too long, because maybe it will run more. Hold losing trades because I can't afford to lose this much. High expectations turn trading from a long-term process into a short-term gamble. Professional traders think in years. New traders think in weeks. Desperate traders think trade by trade. When you set unrealistic goals, you push yourself into extreme psychological states. A winning trade is no longer part of a system. It becomes proof that I'm on the right path to getting rich fast. And a losing trade is no longer a business expense. It becomes a disaster. A slap in the face of your dream of changing your life. So you start revenge trading. Start entering trades to win back what was lost. Start ignoring bad signals because I can't lose again. The higher your profit expectations, the lower your ability to follow discipline. Because discipline usually brings slow growth, but your mind is addicted to fast growth. You don't lose because your system is bad. You lose because you force that system to do what it was never designed to do. A system with a 55% win rate and 1 to 1.5 RR can make you wealthy, but only if you give it time. If you force it to make you rich in 2 months, you will raise risk to a level it cannot withstand, and your account will break before the statistical edge has time to play out. The market does not reward impatience. It only rewards endurance. But beginners don't want endurance. They want breakthroughs. And that rushed breakthrough leads them straight to failure. Reason 3. No clear money management system. This is the point where many traders think they understand, but in reality have never truly applied correctly. They know the concept of risk management, know that they shouldn't go too big, know that they should divide risk. But knowing is completely different from consistent execution. New traders spend 90% of their energy trying to find the perfect entry. They analyze every candle, adjust every indicator setting, wait for the perfect setup. But once in a trade, they almost completely hand control over to emotions. Position size is not fixed. Stop loss is not based on market structure, but on how much pain they can tolerate. Take profit changes depending on mood. They are not trading a money management system. They are trading feelings, and feelings are the fastest changing thing in the market. Money management does not exist to maximize profits. It exists to make sure you still have money to keep playing. Professional traders understand one simple truth. As long as there is capital, discipline, and a system, opportunities always come back. New traders are the opposite. They want to win big when opportunity appears. And in trying to win big, they take risks that can eliminate them from the game in just a few trades. An account that can survive 20 consecutive losses is an account with a chance to survive. An account that can only survive 5 consecutive losses will eventually disappear. Not because the trader is stupid, but because probability does not favor someone betting too big. When you don't have fixed risk rules, each losing trade shakes your psychology more, because you're not just losing money. You're losing a large portion of your account. And when your account drops sharply, your brain switches to survival mode. At that point, you're no longer trading your plan. You're trading to escape pain. That's when the biggest mistakes begin. Overtrading, moving stop losses, entering without setups, disguise martingale under the name of confidence in analysis. All of it starts from not limiting risk from the beginning. Money management is like a seatbelt in a car. You don't wear it to go faster. You wear it so that when an accident happens, you're still alive. Trading is the same. Accidents are guaranteed. Losing streaks are guaranteed. If you don't prepare for that certainty, one bad period is enough to erase years of effort. You don't fail because the market is too cruel. You fail because you walked onto a battlefield without armor. Reason 4. Not controlling emotions. When money starts moving before entering a trade, everyone is rational. Everyone talks about discipline. Everyone believes they will follow the plan. But when the trade starts going negative, a different person appears. Your heart beats faster. Your eyes stick to every tick. Your brain no longer analyzes market structure. It just tries to escape discomfort. Trading is one of the rare games where your money dances in front of your eyes every second. And the human brain is not designed to stay calm in that situation. When money goes up, dopamine is released. You feel more skilled than you really are. You want to enter more trades, increase size. When money goes down, cortisol and adrenaline rise. You enter stress mode. You want to close immediately or freeze and refuse to cut. The problem is not having emotions. Everyone has them. The problem is letting emotions make decisions instead of the system. You place stop loss at a logical level. But when price gets close, you move it further away because it will probably bounce. You place take profit with a logical RR. But when the trade is in profit, you close early out of fear of losing gains. The result? Losing trades lose more than planned. Winning trades win less than planned. Just flipping this ratio is enough to turn a system with an edge into a losing one. Traders fail not because they don't know entries. They fail because they can't maintain their rational version when money fluctuates. The market doesn't attack your account first. It attacks your nervous system first. If you don't have ways to manage psychological state, taking breaks after losing streaks, reducing size when unfocused, not trading when angry or overly excited, then sooner or later you will personally break every rule you once set. The biggest enemy of a trader is not on the chart. It is in their own unconscious reactions. And if you don't learn to recognize when you're trading with emotion instead of system, Every strong market movement will pull you further away from discipline, until your account is no longer large enough to give you another chance to fix your mistakes. Reason 5. Refusing to cut losses. Treating a loss as a personal failure. This is where ego destroys accounts faster than any candlestick pattern ever could. In theory, everyone knows they should place a stop loss. Everyone understands that losses are part of a probabilistic game. But when price actually reaches that stop loss, it is no longer theory. It is the feeling of losing real money. And your brain doesn't interpret it as a planned losing trade. It interprets it as, I'm wrong. My analysis is bad. I lost. That feeling hits your ego directly. And ego hates being proven wrong. So you begin negotiating with the market. It's probably just sweeping stops, then it will go up. The higher time frame still looks good. News is coming, maybe it will reverse. You move your stop loss a little farther, then a little farther, and finally, you delete it completely. A small planned loss turns into a large, uncontrolled wound. Professional traders treat stop loss as a cost of doing business, like rent, electricity, payroll. New traders treat stop loss as a personal failure. And because they don't want to feel like a failure, they let the market decide when they can't take it anymore. The irony is this: the more you refuse to accept small losses, the more you end up absorbing massive losses. A small cut hurts for a few minutes. A big wound can take a whole year to recover from if you still have capital left to recover. Not cutting losses according to plan also creates an even more dangerous psychological habit. You begin to believe, if I hold it long enough, it will come back to break even. Yes, sometimes price will return. And those lucky escapes reinforce the wrong habit. You don't realize you're no longer trading. You are praying. Trading runs on probability and discipline. Prayer runs on hope and emotion. Those two cannot coexist long-term inside the same account. A mature trader is not proud because he caught a top or bottom. He is proud because he cut a loss exactly as planned without hesitation. Because he understands one simple but brutal truth. You cannot control where the market goes, but you can always control how much you lose when you are wrong. And in trading, the survivor is not the one who is always right. It is the one who is always wrong small. Reason 6. Averaging down when you're wrong. Adding positions to feed hope. This is a trap disguised under a very beautiful name: improving your average entry price. It sounds smart. Price goes against you, you add more to get a better average. If price bounces a little, you're break even, or even in profit. The problem is, you're doing that while the market is proving you are wrong. Instead of reducing risk when you realize your analysis is off, you increase risk. Not because your system demands it, but because you don't want to accept that the first trade was wrong. Every time price moves against you, you don't see a warning sign. You see a chance to get it back. So, one wrong trade becomes two becomes three. Size balloons while market structure increasingly moves against you. At some point, you're no longer trading the chart. You're trading the drawdown number on your account. I'm down too much, I can't cut here. Just a little pullback, that's all I need. But the market doesn't know where you entered. It doesn't care how many positions you added. It simply continues following supply and demand. Averaging down while wrong creates an illusion of control. You feel like you're actively managing the situation. In reality, you're only delaying the moment you must face the truth. Professional traders can add to positions, but they add when the market is going in their favor, when profit has already cushioned risk for the added entry. Failing traders do the opposite. They add when the market is going against them because they want to reduce pain, not because they are increasing statistical edge. One wrong trade with one R risk might be only a scratch. 3 wrong trades stacked on top of each other can be a broken bone for an account. And the most dangerous part is, sometimes this strategy still survives. Price reverses, you get out at break even, maybe even profit, and your brain records it as proof. See, averaging down can save me. But you don't realize you survive by luck, not by discipline. Luck in trading is like borrowing money from your future. Sooner or later, you must repay it. And the interest is usually very high. One day the market won't come back in time. The trend will run longer than your account can endure. And then, all those previous miraculous escapes were only stepping stones leading you to a bigger collapse. You don't fail because you entered one trade wrong. You fail because you refuse to be wrong small and try to turn one mistake into a larger gamble. Reason 7. Lazy thinking, wanting money, but not wanting to do the work of a trader. This is a truth most people don't want to hear. Many people are attracted to trading because they believe it's a way to make money without a boss, without an office, without physical labor. They want financial freedom, but they don't want the process of training their mind and discipline to deserve it. They watch a few analysis videos, join a few Telegram groups, learn a few price patterns, and they think they now know enough to take money from the market. But trading doesn't pay for scattered knowledge. It pays for stable decision-making across hundreds of repeated situations, and that requires something many people avoid: sitting alone, reviewing trade history, analyzing mistakes, journaling, adjusting the system. This work is not exciting. There is no dopamine, no feeling of "I place a trade and money comes." It is more like going to the gym than playing a game, repeating boring movements to build a foundation. Failing traders often only like the stimulating part of trading: placing trades, watching price move, emotions rising and falling. They don't like the silent part: backtesting, journaling, tracking performance, realizing exactly where they are wrong. They want signals, want others to give them entries, want to copy trades, because thinking is tiring and taking responsibility is pressure. But the market does not reward lazy thinking. It only transfers money from the unprepared to the well-prepared. When you don't clearly understand why you entered a trade, you won't know what to do when the market behaves differently than expected. You will swing between closing early, moving stop loss, adding positions, because you have no solid mental foundation to hold on to. Professional traders can lose money on a trade, but they always know why they entered, why they exited. Lazy thinking traders are the opposite. They can win a trade, but they don't know why. And because they don't know why, they can't repeat what works consistently. Trading looks like a chart game on the surface, but in reality, it is a game of disciplined, repeatable thinking. If you only want the money but don't want the work, the market will teach you an expensive lesson. No one gets paid long-term for being shallow. Reason 8. Depending on other people's analysis. Having no personal access. In the beginning, learning from others is normal. Everyone needs guidance, but many traders get stuck forever in that stage. They don't learn to stand on their own. They learn to keep leaning. Every day they open the chart not to read the market, but to see what the mentor says today, whether the group calls buy or sell, which direction the YouTube expert is leaning. They don't build their own perspective. They borrow someone else's perspective. The problem is, when you follow others, you only receive the entry point. You don't receive their psychology, risk tolerance, and trade management plan. The signal giver might tolerate a -3R drawdown calmly because they trade a large account with small risk. But you follow with a position size beyond your capacity. When price goes against you, they stay calm. You panic. You close early out of fear, or hold and hope, while the person you followed may have a completely different plan. In the end, you lose money, then blame it on a bad signal. But the truth is, you never truly understood that trade. You copied the surface, not the internal structure. Successful traders use other people's analysis as reference material. Failing traders use it as their only compass. Without your own system, you will always wobble. Today this person sounds convincing. Tomorrow, another person sounds more right. You enter trades with 2 or 3 conflicting opinions in your head. And when the market shakes, you don't know who to trust. That inconsistency kills psychological stability. You never feel confident enough to hold trades according to plan, because it was never truly your plan. Trading is a journey of building an internal axis, a set of principles that stays stable no matter how noisy the outside world becomes. If you always need someone else to confirm before you enter, then you are not the one trading. You are simply renting temporary belief, and when the market moves violently, that rented belief collapses fast. Reason 9. Confusing luck with skill. Addicted to the feeling of all in and winning. This is the most dangerous trap after those early winning streaks. Many traders don't lose at the beginning. They win early. A few big trades, a few heavy entries. The market moves in their favor. The account grows quickly. That feeling is extremely addictive. You no longer see yourself as a beginner. You start believing you have market intuition, a special feel, an ability to read order flow. But the truth may be much simpler. You were just on the right side of probability for a short period. The problem is, the brain doesn't like thinking it was lucky. The brain prefers believing it is skilled, so you start increasing position size. Ignoring risk management because my entries are very accurate lately. Going all in more often because this setup is so clear. You don't realize you're building habits based on short-term results, not long-term process. A good system can win 10 trades in a row. A bad system can also win 10 trades in a row. A winning streak does not prove you are good. It only proves that probability is leaning your way for a short time. But when you start believing that streak comes from superior skill, you loosen every discipline rule that once protected you. Then when the market changes phase, volatility shifts, your familiar setup stops working the same way, you still trade large like before. And at that moment, the market doesn't take back slowly, it takes back very fast. Many traders spend months earning their first profits, and only need a few days to give it all back, plus their initial capital, not because they suddenly became stupid, but because they confused luck with skill and built high-risk behavior on top of that illusion. Mature traders are always suspicious of their own winning streaks. They reduce excitement, keep size stable, follow rules even when they feel in sync with the market. Failing traders do the opposite. They trade small when afraid, and trade big when euphoric. Even though both states are enemies of consistency, the market does not punish you for being confident. It punishes you for increasing risk based on emotion instead of long-term statistical edge. And the lesson usually comes late, after the account has returned to the starting line, or worse. Reason 10. Blaming others. Refusing to take responsibility for trading results. This is the clearest sign that a trader will stay stuck for a very long time, or leave the market in bitterness. When they lose, they rarely look at their own decisions first. They look outward, blame the news, blame smart money, blame the broker, blame the signal provider, blame market manipulation. Sometimes those factors exist, but if every loss has an external villain, then you have removed your own power to change future results. Because if the fault always lies outside, then you don't need to fix anything. Mature traders have a completely different reflex. When they lose, the first question is, did I follow my plan correctly? If the answer is yes, they accept the loss as part of the system. If the answer is no, they know exactly what behavior must be corrected. Blamers never go through this process. They only have frustration. They jump from group to group, from one method to another, always searching for something better instead of becoming a better version of themselves. Trading is one of the few fields where you cannot escape yourself. There is no boss to blame, no teammate to take responsibility for you. Every mouse click is your decision. Every position size is your choice. Every time you move a stop loss is also you. When you fully accept responsibility, something strange happens. You start to feel power, because if results come from your behavior, then changing behavior can change results. But if you believe the market is always out to get you, then no matter how much knowledge you gain, you will still feel like a victim. And victims cannot become consistent traders. The market does not require you to be right all the time, but it demands that you grow up. Maturity in trading means looking straight at your own mistakes, without avoidance, without excuses, without blame. Because only when you take 100% responsibility for your account do you truly begin to control it. And that is also the final line between the ones who keep spinning in circles and the ones who slowly move into the 5% who make it.